welcome you. You sent us a really thought-provoking paper, Stephen Miran's User's Guide to Restructuring the Global Trading System. Came out last November.
Yeah.
And, given his background, U.S. Treasury senior strategist,
Yeah.
this feels like, well, more than just theory, right? It feels like a potential roadmap for economic policy.
Absolutely. It's exactly the kind of thing we like to dig into here. What's striking about Miran's piece is how direct it is. He's focused on reshaping things, international trade, finance.
Not just diagnosing.
Right, not just diagnosing. He's laying out tools specifically aimed at boosting America's economic position. So your interest in understanding this, it really puts you ahead of the game, I think.
Okay. Yeah, the big picture seems to be potential for some pretty major shifts in how global trade works. Miran really focuses on two main levers, doesn't he? Tariffs and currency policy.
That's right.
Tariffs, we've all heard about those.
Yeah.
But his take, and especially how currency adjustments might play into it, well, there are some surprising angles we definitely want to unpack with you.
And it's important to remember, Miran isn't necessarily saying do this or do that. It's more about laying out the options, looking at the pros and cons, how you might deal with the fallout.
Understanding the mechanics.
Exactly. Understanding the mechanics, the potential market reactions, even if some of these policies are, let's say, politically charged.
Okay, so let's get into the foundation of his argument. The paper kicks off highlighting this ongoing problem, the dollar's overvaluation. What's the main driver, according to Miran?
Well, his core point is all about the dollar's unique role. It's the world's reserve currency.
Right.
And that creates this constant, almost built-in demand for dollar assets, especially U.S. treasuries. And this demand isn't always linked to the typical things that balance trade between countries.
He uses this phrase, Tariff world. Can you break that down simply?
Sure. Think of it like this. The world needs a global currency, right? For trade and also as a safe place to store savings. That's the demand side. In this Tariff world, the country issuing that currency, so the U.S. with the dollar, has to supply enough of it to meet those global needs. It doesn't matter if our own trade books are balanced or not. The demand for dollars isn't just about whether we're selling more stuff than we're buying.
So because everyone needs dollars, the demand keeps its value high, even if our trade deficit is huge.
Precisely. And the result, as Miran explains, is that the U.S. often runs these persistent current account deficits, basically importing more than we export. That's the flip side of supplying those reserve assets, like treasury bonds, to the world. You could almost say treasuries become a major U.S. export. Dollars go out to pay for imports and come back in to buy those bonds. So the reserve status itself builds in this imbalance. The U.S. has to prioritize providing safe assets over achieving balanced trade. That's the core tension Miran sees.
And that really hammers American manufacturing, doesn't it? The sectors that actually trade goods internationally.
That's the crux of it, yeah. A strong dollar makes our stuff more expensive for foreigners and makes imports cheaper here, puts U.S. producers at a disadvantage.
Right.
And Miran makes a key point. As the U.S. share of the global economy, the global GDP, has shrunk, from maybe 40% back in the 60s down to about 26% now, this burden of supplying the world's money gets relatively heavier for our domestic economy.
That really helps explain some of the economic discontent you hear about.
Yeah.
It's not just about this trade deal or that one. It's deeper, baked into the dollar's global role.
Exactly. And Miran doesn't shy away from the national security angle either. That's clearly a big motivator here. He even quotes President Trump, "If you don't have steel, you don't have a country."
Highlighting the need for a domestic industrial base.
Right, especially with geopolitical rivals like China and Russia on the scene, you need that robust manufacturing capacity.
The paper also flags worries about relying on allies for critical supplies, and even mentions things like Chinese cyber attacks and port cranes.
Yeah, concerns about potential espionage like hacking, or even control over a critical infrastructure like those port cranes. It all feeds into this argument for bringing production back home, or at least relying less on potentially untrustworthy partners for security.
Okay, so Miran mentions two ways to think about currency equilibrium. One's about balancing trade, the other's about what investors want. How does being the reserve currency mess with the investor's side?
Well, normally you'd expect exchange rates to adjust over time to help balance imports and exports. That's the trade balance idea.
Okay.
But when your currency is the reserve currency, investor preferences, especially big players like central banks and sovereign wealth funds needing a safe haven for huge sums of money, become a massive driver of its value.
So it's not just about trade flows.
Not at all. This demand for safety for dollar assets can be really strong and kind of disconnected from whether the U.S. is running a trade deficit or surplus. It keeps the dollar high even when traditional trade logic might say it should fall. Think of it like countries needing dollars, almost like a utility, regardless of the price in trade terms.
Gotcha. Okay, so the reserve status is the core problem identified. Let's move to the solutions Miran explores. First up, tariffs. We saw those used against China in 2018-19. What's his take on that experience?
Well, he notes that despite pretty hefty tariffs back then, the overall hit to the U.S. economy seemed, well, surprisingly small. Inflation didn't really take off, GDP growth kept going.
Right.
And that experience is kind of exhibit A for people arguing that tariffs might not be the economic disaster some predict.
And he brings in this concept of currency offset to explain why inflation didn't spike as much as expected.
Yeah, that's a key mechanism he discusses. The idea is if the U.S. puts tariffs on, say, Chinese goods, the Chinese currency, the yuan, might weaken against the dollar. And that weakening can cancel out the price increase from the tariff. So the tariff makes the good more expensive in dollars, but the weaker yuan makes it cheaper for the Chinese exporter to produce or sell, potentially leaving the final dollar price for the U.S. importer relatively unchanged.
He gives that little equation, PM equals E1 plus PXX. Can you walk us through that again?
Sure. PM is the price the U.S. importer pays in dollars. ES is the exchange rate, how many dollars buy 1 yuan. Tau is the tariff rate, the tax percentage. And PX is the price the Chinese exporter sets in yuan.
Right.
So if the tariff goes up, making 1 plus bigger, but the exchange rate E goes down, meaning the yuan gets cheaper, so fewer dollars by 1 yuan, those two changes can effectively cancel each other out. The final dollar price pyramid might not change much.
Okay, but the paper notes there's some debate about the inflation impact. The big picture macro data didn't show much inflation, but some micro studies, looking at specific products, did find price increases. What's the story there?
Exactly. You had overall inflation staying pretty tame, but these specific studies, looking at import prices, maybe even at the retail level, found prices did go up, often by pretty close to the full tariff amount. Research by folks like Cavallo, Feigelbaum, Amidi.
So suggesting consumers did pay.
That's what those studies implied, yeah. They suggested that the expected fall in the exporting country's currency, or maybe a cut in the exporter's price, didn't fully happen, or at least didn't fully pass through to the final price paid by U.S. importers or consumers.
But Miran pushes back on that interpretation a bit, right?
Yeah.
He offers reasons why those micro-studies might not tell the full story.
He does. He makes a few key points. One, those studies often focus on the very short term. It might just take longer for exchange rate changes to filter through, especially if importers are using hedging strategies.
Okay.
Two, some analysis suggested that even if importer costs went up, retailers didn't always pass the full increase onto shoppers. They absorbed some of it, squeezing their own profit margins.
And then there's this big one about companies just avoiding the tariffs.
Yeah, this is really critical. Miran cites work showing a big jump in Chinese firms shipping goods through other countries, Vietnam, Mexico, wherever, to dodge the U.S. tariffs aimed at China directly.
Transshipment.
Exactly. So the goods that were still coming directly from China, the ones showing up in that microdata as facing the tariff, were probably the ones where Chinese exporters had more pricing power and could pass the cost on.
And the ones where they couldn't.
They likely got rerouted, so they wouldn't be in the data for direct U.S.-China imports subject to tariffs. This really skews the results of those micro-studies, Miran argues.
So the takeaway for you, the listener, is that those apparent price hikes in the micro-studies might be misleading because they're missing all the goods that found a way around the tariff.
That's the argument. It suggests the direct cost to U.S. consumers might have been less than those studies imply because a lot of trades simply shifted.
So Miran thinks the overall inflationary impact, especially if you get that currency onset, could be pretty manageable.
He suggests it could be quite modest, yeah. Citing estimates by Kita Gopinath, maybe in the range of 0 to 0.6% added to consumer price inflation. But he does add the caveat. It depends on the overall economic climate and inflation expectations at the time.
And if the Chinese currency does weaken enough to offset the tariff, who actually ends up paying for it?
In that scenario, where the dollar price doesn't really rise, it's effectively China bearing the cost. Their currency buys less internationally. Meanwhile, the U.S. Treasury collects the tariff revenue.
But the paper also warns that this currency offset itself isn't without risks. It could cause financial market instability.
That's the potential downside, yes. While it might keep consumer prices stable here, a big, rapid drop in a major currency like the yuan, especially given China's existing debt levels and capital controls, could spark capital flight and major turbulence in their financial markets.
With potential global spillover.
Potentially, yes. That kind of financial shock could actually be more disruptive than just slightly higher prices at the store here.
Okay, so how likely does Miran think this currency offset scenario is, looking ahead?
He leans towards it being the more likely outcome, actually. He acknowledges some counterarguments like the dollar being stronger now than in 2018, maybe different interest rate dynamics. But he pushes back on the idea that worries about U.S. government debt would prevent the dollar strengthening if tariffs go up, especially since the tariffs themselves bring in revenue.
Right.
And he points out the dollar did gain value during the 2018-19 episode, even when U.S. interest rates weren't exceptionally high compared to others. So, past experience suggests offset is plausible.
Now, let's talk implementation. Miran emphasizes that how you impose tariffs matters a lot for minimizing disruption. What strategies does he highlight?
Gradualism and clear communication are key. He suggests announcing clear demands to the target country, maybe China opening markets, better IP protection, whatever, and then slowly phasing in tariffs, maybe even small, regular monthly increases, until those demands are met.
Kind of like Fed forward guidance.
Exactly like Fed guidance. The goal is to reduce business uncertainty, give firms time to adjust supply chains, and apply steady pressure rather than a sudden shock.
He also discusses this more complex idea, varying tariff levels based on a country's broader behavior.
Yes, this is a concept linked to Scott Bessent. The idea is to create tiers or categories. Countries might face different U.S. tariff rates based on a whole checklist. Are their trade rules reciprocal? Do they manipulate their currency, protect IP? Are they meeting security alliance commitments like NATO spending? Even their stance on global issues.
So market access becomes conditional.
Precisely. It turns access to the huge U.S. market into leverage, a tool to incentivize behavior you want, not just on trade, but potentially on security and other geopolitical fronts, too.
So tariffs become this multi-purpose tool, influencing global politics, not just trade balances.
That's the implication. Miran even suggests this could be used to build a sort of multilateral tariff coalition against, say, China. Put pressure on other countries. Either join us in tariffing China, or maybe face tariffs on your exports to the U.S.
And he connects this to fiscal devaluations. What's that?
It's the idea that a combination of policies like import tariffs paired with, say, export subsidies, or maybe cuts to domestic production taxes like payroll taxes, can mimic the effect of a currency devaluation.
How so?
It makes imports more expensive and effectively makes domestic production cheaper or airports more profitable, boosting competitiveness just like a weaker currency would.
And this all ties back to wanting to keep domestic taxes low. Corporate taxes, income taxes.
Miran definitely makes that link. Tariff revenue flowing into the Treasury could help pay for maintaining lower domestic tax rates, like those from the 2017 Tax Cuts and Jobs Act. Those lower rates are seen as crucial for encouraging investment and job growth in the U.S.
Okay, one last point on tariffs. Mira mentions optimal tariff rates, the economic theory that for a big country like the U.S., some level of tariffs might actually be beneficial overall.
Yes, it's a classic trade theory argument. A large economy, one that's a major buyer on world markets, can potentially use tariffs to push down the prices it pays for imports from the rest of the world, improve its terms of trade. This could theoretically increase national welfare.
And he uses a number.
He mentions theoretical estimates suggesting an optimal rate for the U.S. might be around 20%. And he notes that some current tariff proposals are kind of in that neighborhood, maybe averaging out to 17% or so.
But there's a huge catch.
A massive catch.
Yeah.
Retaliation. If other countries retaliate with their own tariffs, it likely wipes out any potential benefit. Miran acknowledges this risk fully.
Though he argues the U.S. might be better positioned than China in a trade war.
He does suggest that, partly due to China's capital controls, making it harder for them to withstand certain pressures, and also the possibility of the U.S. linking trade policy with security policy to discourage retaliation. But it's definitely a high-stakes gamble.
Okay, that's a really comprehensive look at the tariff side. Let's pivot now to the second major tool Miran discusses, currencies. He frames this as having a very different risk profile. What are the main dangers?
The number one risk with actively trying to manage the dollar's value downwards or push other currencies up is scaring foreign investors.
How so?
If policies make holding dollar assets, especially U.S. treasuries, seem less attractive or riskier, you could see large capital outflows. foreigners selling off treasuries.
Which would push up interest rates.
Exactly, particularly long-term interest rates. That could really hurt interest-sensitive sectors in the U.S., like housing. It's a major potential negative consequence.
And a weaker dollar itself could fuel inflation domestically.
Yes, that's another risk. Miran again cites estimates suggesting, say, a 20% fall in the dollar could add maybe 0.6 to 1 percentage point to CPI inflation.
How might the Fed react to that?
Well, the Fed might initially see it as a temporary price adjustment. But if they worry it could lead to persistently higher inflation or unanchor inflation expectations, they might feel compelled to raise their own policy interest rates in response.
Although for U.S. companies selling abroad, a weaker dollar isn't all bad, right?
True. It makes the products cheaper for foreign buyers, boosting export sales. And when they convert profits earned in foreign currencies back into dollars, those profits are worth more. So it can be a positive for corporate earnings from international operations.
Okay. Historically, major currency realignments involved international cooperation, like the Plaza Accord in '85, the Louvre Accord in '87. How feasible is something like that today?
Miran is pretty skeptical about a broad Plaza-style agreement now. He points out Europe's sluggish growth and China's export-driven model make them unlikely candidates to voluntarily strengthen their currencies significantly against the dollar.
They wouldn't want to hurt their own exports.
Exactly. Maybe some smaller economies like Japan or Canada might be more open, but they just don't have the scale to move the needle on the dollar by themselves. The geopolitical and economic landscape is just very different from the 1980s.
But he does float this more contemporary idea, a potential Mar-a-Lago Accord. What's the thinking there?
This concept, drawing on ideas from Zoltan Pozsar, really tries to link security and finance explicitly.
Right.
The basic idea is countries under the U.S. security umbrella could be encouraged, maybe nudged by the threat of tariffs, to invest their dollar reserves into very long-term U.S. Treasury bonds, maybe even 100-year bonds,
Long-term.
to help finance the U.S. security presence and lock in that funding, keeping U.S. borrowing costs lower over the long haul. In return, these allies might get concessions, like lower tariffs on their goods, and perhaps they'd agree to let their own currencies appreciate somewhat against the dollar. It's basically trading security guarantees and market access for long-term financing and currency adjustments.
Wow, it's a fundamentally different model.
Yeah.
What are the main obstacles to pulling that off?
Several big ones. Miran notes that today, unlike in the 80s, a huge chunk of reserves are held by Middle Eastern and Asian nations, not just European allies. Dealing with them requires totally different diplomacy. Plus, a massive amount of U.S. debt is held by private investors globally, not governments. They wouldn't be part of any such accord, and their reaction to a potentially weakening dollar is a huge unknown. Could they sell off treasuries en masse?
So multilateral currency action looks tricky. What about the U.S. just going it alone? Miran seems to think there are unilateral options challenging the Wall Street view.
He does. He specifically highlights the International Emergency Economic Powers Act, IEPA.
What does that allow?
It gives the president really broad powers to regulate international financial flows during a declared national emergency, which could potentially include economic threats.
And how could that be used on currencies?
Miran suggests one possibility is using IEPA to impose a small fee, or effectively withhold a bit of the interest, on U.S. Treasury securities held by foreign official institutions, like central banks.
Why? What's the justification?
The argument would be that massive foreign reserve accumulation keeps the dollar artificially strong, hurting U.S. exporters. This fee would be framed as recouping some of that cost imposed on the U.S. economy.
That sounds controversial, like a partial default.
That's the big fear, yeah. It could be seen that way and spook markets badly. Miran acknowledges this, suggesting it would need careful legal structuring, perhaps framed as a user fee rather than withholding interest, but the risk of market backlash is definitely high.
How could they try to manage that risk?
He suggests several mitigating steps. Start with a very small fee and increase it gradually, giving markets time to adjust. Differentiate between countries, maybe hit adversaries harder than allies, and crucially, try to get the Federal Reserve on board to help manage any resulting interest rate volatility.
Would the Fed cooperate?
Miran argues their mandate includes moderate long-term interest rates, giving them a potential justification to intervene, maybe using tools like they did in Operation Twist historically. But Fed independence is key here.
Okay, what's the other unilateral approach Miran discusses? The U.S. actually buying foreign currencies.
Right, basically mimicking what many other countries do, intervening in the currency market. The U.S. Treasury's Exchange Stabilization Fund, ESF, or maybe even the Fed itself, could sell dollars and buy euros, yen, etc.
To push the dollar down.
to increase demand for those foreign currencies and hopefully cause them to strengthen against the dollar, thereby weakening the dollar itself.
What are the downsides there?
Miran lists several. The ESF is pretty small relative to global currency markets. If the Fed were to print new dollars to buy foreign currency, that could be inflationary unless they sterilize it, meaning sell treasury bonds to soak up the extra dollars they created.
Which could push interest rates up, kind of defeating the purpose.
Potentially, yes. Or at least complicating things. There's also the risk of losing money if the foreign currencies the U.S. buys then fall in value, a negative carry. And of course, foreign governments might retaliate against the U.S. intervening in their currency markets.
All right, let's bring this back to the markets. Thinking about all these potential policy shifts, tariffs, currency moves, what's the general expectation for market volatility?
Miran suggests a second Trump term would likely be very focused on these goals, perhaps as part of a legacy push. So the intent would be strong.
Which means more volatility.
Potentially, yes. But he also notes President Trump has historically paid close attention to stock market performance, which might argue for a more gradual, carefully managed approach rather than sudden, disruptive shocks.
And the sequencing probably matters. Tariffs first.
That seems to be the expectation. Tariffs are more familiar, they generate revenue, and they can be used as leverage for other negotiations, including potentially on currency. Miran anticipates the initial phase, focused on tariffs, might actually be dollar positive due to revenue generation and potential currency offset.
He also mentioned tariffs potentially being traded away for big investment commitments in the U.S.
Yes, that's floated as a possible off-ramp, similar to some deals in the Reagan era. Get foreign companies to build factories here, create jobs, in exchange for tariff relief.
But with maybe more skepticism about follow-through this time.
Exactly. Given past experiences, particularly with China, Miran suggests the U.S. might demand stronger guarantees or enforcement mechanisms this time around.
What about inflation and the bond market during all this?
The paper suggests an administration pursuing these policies would likely try hard to offset any inflationary pressures through other means deregulation, boosting domestic energy supply to lower costs, cheap energy. These could help soothe bond markets.
And the differentiated tariff idea comes back too.
Right, potentially linking lower tariffs to allies sharing more of the security burden that could also influence market reactions.
Okay, and shifting to currency policies, the market impact seems really dependent on whether it's a coordinated move or the U.S. acting alone.
Definitely. A multilateral deal like the Mar-a-Lago Accord concept could, in theory, see the dollar weaken and long-term U.S. interest rates fall simultaneously, especially if allies lock into long-term bonds. But that's a big if and depends heavily on private investor reactions and Fed coordination.
Whereas unilateral moves are riskier.
Much riskier for volatility. Using IEPA fees or large-scale direct intervention selling dollars could cause serious market jitters. You might see higher short-term rates and a flatter yield curve if the Fed tries to sterilize, or potentially a spike in long-term yields, higher term premia, if they don't or can't fully offset the market impact.
So gradualism is key there.
Absolutely. Miran stresses gradual implementation and potentially using other Treasury tools like managing bond issuance strategically, activist Treasury issuance, or using the ESF alongside those broader deregulation and fiscal efforts to try and keep markets stable.
Okay, wrapping up, what are the biggest overall implications Miran sees if we head down this path of restructuring global trade?
He foresees a much sharper divide emerging friendly trading partners, adversaries, and maybe some neutral countries in between. And asset prices are likely to reflect those distinctions much more clearly.
A more fragmented world.
Yes. And the potential threat of the U.S. pulling back its security umbrella if allies don't contribute more could itself be a major source of geopolitical instability, pushing countries toward more independent defense spending.
And for currency markets?
He expects a structural increase in volatility, bigger swings in exchange rates becoming the norm, and intensified efforts globally to find alternatives to the dollar and dollar assets.
Does he think the renminbi takes over?
He seems skeptical about the renminbi becoming a true global reserve currency alternative anytime soon due to China's own capital controls and other issues, which might, interestingly, boost assets seen as outside the traditional system, like gold or maybe even cryptocurrencies.
This has been, wow, A really comprehensive deep dive into Miran's framework. It certainly gives us, and you listening, a lot to think about regarding potential shifts in global trade and finance.
Absolutely. Understanding these tools, the underlying problems they're meant to address, and the potential ripple effects, it's crucial context for anyone trying to navigate what could be a very different economic landscape ahead.
Definitely. And maybe a final thought for you to consider. Miran's analysis really highlights this deep intertwining of trade, finance, and national security. How might that connection fundamentally reshape not just economic policy, but global alliances and geopolitical stability itself in the coming years? Something to mull over. Thanks for joining us for this deep dive.